Hey YouTube, this is Steven with On My Way to FIRE, channel about early retirement and all things investing. And in today's video, I'm coming to you at Huntington Beach, California. About a quarter mile here away from the pier. And I want to do a quick video topic on investing and how it feels like riding a roller coaster sometimes. If we follow the financial media like CNBC, Bloomberg, MarketWatch, those kind of sites, Fox Business, it's easy to get swayed by the big headlines of a certain company like Nvidia or Google making an all-time high. And maybe we're invested in it, maybe we're not. You know, for a lot of us, we're just invested in mutual funds that probably have a small percentage in some of these companies. So it's kind of cool to hear about that. But, unless you're a savvy investor or somebody who's a little bit more specialized with their knowledge, you might not hold some of these single stocks. So I just wanted to do a quick video and talk about managing expectations as we reach highs in the, 52-week highs in the Russell Index, NASDAQ, and S&P 500. And what I found interesting is that the S&P 500 funds, for the most part, are weighted, meaning that the big companies like Nvidia, Apple, Google, Microsoft, they tend to have a higher percentage within the S&P 500 compared to all the rest of the companies. So it's not really a true barometer of the 500 companies. It's just a blend of 500 companies with some of the biggest companies leading the way in terms of percentage. And so it really just comes down to perspective, managing our expectations and not getting caught up in all the hype. I have delved into single stocks. I don't have as much technology as I should, and I don't really have any single technology stocks outside of a handful. But as I'm learning and growing with my knowledge, I am comfortable buying some of these companies now, but it's really hard to when they're reaching 52-week highs continually. So I'm more of a value-minded investor. I like to take my time. I like to get money set aside when I'm trading in my brokerage. And as far as my 401k, that's pretty much automated. It's gonna just keep buying every 2 weeks. So that one, in some respects, can perform better because it's taking the human element out of it. And that's what they call friction. And the friction is you having to place the buy order. If you have a set percentage going to certain mutual funds that have some of these companies in there, it's just gonna do it on a regular basis. Where on a brokerage account, you can automate deposits in terms of the cash dropping into the account if you want to trade on your own for a taxable account. But for the most part, you have to select when to buy these companies. And if you see that the company's at a 52-week high, you might not be inclined to buy it that day. Just depends on what type of investor you are. And for me, I have a really hard time buying a company at a 52-week high. I continually look for 52-week lows, and I'm willing to buy while it's low because I figure it's come down and it's going to do this for a while, and then eventually it should come up, but there's no guarantee of that. So when I watch CNBC or Bloomberg, they're pretty much touting the single stock companies like Nvidia and Apple reaching these big milestones, and it can be easy to get left out, and that can go to financial FOMO, fear of missing out. And I talked about FOMO in another video just in general about life events and going places and taking fancy vacations. But I see financial FOMO occasionally, and I've experienced it. I would say Amazon was down recently towards the end of February going into March, and I set aside some money and I was able to buy some. But I put a lot of pressure on myself to be able to do that. And I don't know if it's good or bad. It did work out to where I did spot an opportunity with Amazon, but at the same time, it was probably a little more pressure than I should have had to do that. So it just goes down to your personal trading style, what kind of priorities you have, and long-term outlook. Had Amazon kept going down, I was willing to put more money in it, but I had to get this cash set aside ready to go and make these purchases when I saw the opportunity. And I'm glad I did it. But now that it's come up, I feel a little validated and vindicated that Amazon came up from the low 200s where I bought to, I think it was around 255 to 270. It's kind of gone back and forth in that range. But that's kind of an anomaly for me. I don't normally have that feeling all the time. And I'm more willing to just buy a small amount of shares here and there. And Amazon, you know, is $200 a share. That's not cheap. Most stocks that I buy are between $25 and $50. And if it's an ETF, I might even be able to get away for under $20 a share. So it really just comes down to what is the stock, how much money do I have, and where are we in a market cycle. So I did a little research, and I found that when the market makes a 52-week high, it tends to make additional 52-week highs. And so my mindset seems to think that you get to a point where you reach a high and then it's going to fall off a cliff. And that generally doesn't happen right away. You'll see some sloshing back and forth where it'll reach the high, maybe reach a second or even third 52-week high, and then start drifting downwards a little bit and go sideways, as they call it. So it's really about keeping a long-term perspective in mind. If you're an options trader, you might be more tuned to day-to-day fluctuations, and you can make money off these small moves. But that's not something I do. For a lot of us, we're long-term investors, generally in our 401k, and we're buying and selling out of our brokerage accounts. But a lot of us aren't as sophisticated to, trade an options market. So I hope this video helped you a little bit. We want to stay long and strong. If we stay in the market for decades and decades, we will be rewarded. And so just keep a long-term mindset. I do listen to Dave Ramsey. I have some criticisms as far as some of the things he has to say, but he does have a good saying about riding the roller coaster. And he says the only people that get hurt are the ones that get off the roller coaster before it stopped. So I think that's a really good mindset to have. Continue putting money to work. Don't get caught up in the hype. And when you get to retirement age, then evaluate an exit off ramp. But for now, we're going to keep putting money to work, and we're not going to get caught up in the hype. So we'll see you in the next video.